Hello. Hi, everybody. Okay. I think everything is up and running correctly. So let's not waste any more time. Let's get straight to the point. Welcome to another webinar of our series. Today, guys, we're going to talk about technical analysis. More specifically, we're going to look at candlesticks, so fundamental building blocks, of analyzing past price action, which is essentially what is given with by the charts. What we're looking at and what we're doing with technical analysis today, more specifically, is we're going to deconstruct how candlesticks are formed in order to understand how the whole thing is coming all together. What are the bulls are doing, what the bears are doing, how their fight ends up within a specific time frame, and which in a sense gives us the candlestick print that we're going to see on our chart. We're going to attempt to decode what's going on with the bulls and the bears and how these candlesticks are formed. We're going to break down the basic components, for example, the open, the close, the high, the low of the day, etc. We're going to see how they look, okay? And nearing the end of our session, we're going to provide some sort of basic yet crucial candlestick formations that technical analysts do pay a lot of attention to when they come into fruition, when they manifest, because they give us specific kind of hints of what's going on with that specific price action of that specific instrument. Okay, so the principles can't be applied on any given instrument. Today, we're going to do the fundamentals of candlesticks. Okay, so let's not waste any more time. Let's get straight to the point. This is a quick risk warning and a disclaimer. At the end of the day, the gist of the whole thing here is risk warning is that this information that we contain in this kind of presentations, this webinar series, is for educational purposes only. There's no any sort of investment advice or investment recommendation presented in this kind of webinars. So at the end of the day, this is for pure educational purposes only. Okay, that's pretty much it. Moving on with the agenda. So what we will go over in this kind of session, again, we're going to do a brief intro into candlesticks. We're going to identify what's a bullish and what's a bearish candle. We're going to look at wicks and shadows. Okay. The goal of the webinar is, at the end of the day, to interpret individual candles, understand what information they are conveying, and finally, we're going to provide with you guys with some basic candlestick formations. Okay, so brief history or as a recap of how we came up until this point in regards to usage of the candlesticks. This is a brief and small kind of paragraph saying how we got here, how we ended up here. So candlesticks, in a sense, originated in Japan in approximately the 17th century from a Japanese merchant, more specifically a rice trader named Homer, who discovered that despite the connection between the price of rice and the supply and demand forces, the markets were more influenced by the emotions of traders. Okay, and as we all know, when we're dealing with technical analysis, this is not purely logical kind of mechanistic quantitative price action that takes place. Okay, there is a lot of emotions underway or beneath the surface that influences the direction of instruments in financial markets, and that depends obviously about excuse me, it depends upon the mentality of those that are actually participating in the financial markets, which are traders, institutional traders, banks, whatever that is. Okay. So how markets or how market participants perceive the price or the trajectory of a specific instrument, okay, can be seen via the movement of the instrument, okay, because it reflects not only fundamental data and economic developments and all that kind of stuff. It also encompasses the behavioral kind of attitude of traders, okay? Their perspectives, their visions, their needs and wants. These are all combined, and they are candlesticks are showing you, in a sense, this, okay, the what is the equilibrium, in a sense, of this specific instrument at this point in time, and how these views impact each other, and we come up with the let's just say resolved kind of price level that we see on charts. Okay, so in simple words, okay, emotions of traders and their psychology of traders and their intents do affect markets, which is what allows us as technical analysts to capitalize upon and make money. Simple as that. So it is likely that Homer's original ideas were modified and refined over the many years of trading, eventually resulting in the system that we use, pretty much every trader uses till this day. That is the candlestick chart, or candlesticks in general. Okay, obviously there are many types of charts out there that encompass, or they consolidate, or they showcase price against time, price action against time. For example, we looked at candlesticks, yes, line charts, bar charts, pivot tables, and all that kind of stuff. Okay, pretty much they reflect the price action across time. Okay, most traders, however, to date, they use candlestick. For some reason, this became the most prominent and the most mainstream way of looking at price action of any given instrument in this day and age in financial markets. Okay, so this is an example of a candlestick chart. Okay, visual illustration. So at the end of the day, candlesticks are indeed visually superior to bar charts and line charts. That's why most traders prefer that. But again, if you can trade successfully and profitably the markets using line charts or bar charts or pivot tables or whatever that is, feel free to do that. We just like to use candlesticks, and we present this information in the most easily applicable kind of manner. So one size fits all kind of approach here in regards to teaching or conveying this information towards you. So it's going to be about candlesticks. So bullish and bearish candles, the two types of candle, two main types of candles. Okay, so as you can see on your left-hand side of the corner, we have what we call a bullish candle, okay, which is represented in the color green. Again, I'm going to say this, hopefully I'm not going to say this way too many times. The color is irrelevant, okay? The reason why we use green and red, I'm not sure why, to be honest, but most likely the green means go and red means stop. If you can extrapolate from looking at traffic lights, something like this. So most people trade, most traders during this day and age, they use a green candle representing the bullish movement, whereas a red candle represents the bearish movement. So for the sake of simplicity, we use this. Back in the day when financial markets were not this advanced, or trading software was not this advanced, back in those days, traders used to have white and black candles, pretty much the same thing. White is the equivalent of green, and black is the equivalent of red in today's terms. Okay, by the end of the day, you can use any given color you like. You can do yellow and purple. You can do, I don't know, blue and black, whatever that is. Okay, you can use any given color. The point is to understand what information does the candlestick convey to you. Okay, and how the candlesticks components determine whether it's a bullish candle or a bearish candle. Okay, so we have 4 parameters in this kind of visual illustration from candlesticks. We have open, we have the we have open, we have close price, the highest price and the lowest price. Okay, so you can clearly see that annotated there. So for bullish candles, the rule is the open is always below the close price. Okay, makes sense. Yeah. So if, let's just say, market open at this area right here, price was $100, close price, in order for it to be considered as a bullish candle, the close price must be above it. So $103, whatever that is. So the open price is always lower than the close price if we're talking about a bullish candle. Okay, so this is the rule. So on the flip side of the equation, when we're talking about bearish candles, the open price is always higher than the close price. Okay, so that indicates that the price has fallen over that specific point in time, or that period. Okay, so bullish candles open is lower than the close price. Bearish candles open price is higher than the close price. Okay, so what we have in front of us here is a bullish candle. If we take it from the start, left-hand side corner, white candle is pretty much the same thing. So it has an unusually white slash green body with a wide range between high and low of the day. Okay, this is what we call a real body, is the rectangle without the lines above or below them, what we call wicks and shadows. Okay, so prices for bullish candles tend to open near the low of the day and close near the high. So this is what validates it. This is what stamps it as a bullish candle. So on the flip side of the equation, bearish candles, it has an unusually black or red long body with a wide range between the high and the low, and prices open near the high of the day and close near the low of the day. This is what considered as bearish. I'm going to talk about wicks. Okay, so in a few more slides. So let's go ahead and decompose candlesticks. Okay, we're going to talk about their formation there. So a candlestick is formed with the help of the open price, the high of the day, the low of the day, and the close price of the day. Four main elements. Okay, open, close, high, low. So if the open price is indeed above the closing price, then a field candlestick is drawn. That means there has a body. Okay, so in this kind of a scenario, we're talking about a bearish candle. Okay, so because the price, the open price, is above the close price. Okay, so open at 100, closed at 95. Candle is going to be painted red, black, whatever the color is. At the end of the day, it's a bearish candle because the open is higher than the close. Okay, so normally black color or red color is used for filling the candle, okay, or any other color you see if it can be applied. So if the closing price, the opposite scenario here, is above the opening price, that means price action started at the start of the day, market open at $100 and has closed. Give me 1 second, guys. Has closed near the at a higher price. Okay, so open at 100, close at 110. Okay, that means the candle is bullish. Okay, and we paint it in green or white or any given color again. So bearish and bullish. I hope you understand the differentiation between the two. Okay, so the field portion of the candle is what we call a real body or just body. You can see here, okay, the rectangle in a sense without the two lines, okay, and which can be at many occasions either large or small or excessively large or excessively small, okay, with which is proportion to the volatility or the liquidity of the trading range that we see that price action taking place. Okay, so long, normal, or short with proportions to the line above or below it. So the lines above or below, they do have significance, and we're going to talk about this. So the lines above, long or short, above or below the real body, the thick rectangle that we're talking about, represent the high and the low of the day. Obviously, above is the high, below is the low. And these lines are also known as shadows, tails, or wicks. For this particular example, we're going to call them wicks and shadows. You can use any given terminology you like. Okay, so for the particular day or any time frame you choose, the highest price is declared by the top with the upper shadow or the wick, and the lowest price is marked at the bottom with the lower tail or the shadow. Okay, so please note that the body may or may not have shadows, tails, or wicks. So we may just see a candlestick that is just, let me see if this example has one, with only, I can't see anyone. Can you spot any candle that is indeed without any tails or wicks? No, apparently not, as far as I can see. If you can spot something, guys, let me know. No, but the absence or the presence of wicks does give us significant information. That means if the price action opened here and closed there, there's no swinging. Okay, there's no uncertainty about this level being the optimal one. That means the price action was confined between these two range, within this range between bulls and bears. In this kind of example, in the green one, the bullish candle, we saw price action starting from here, ended up there. Okay, at the end of the day, but we don't know exactly, if we're not looking at price action from like a hawk as it progresses. We don't know. We're not quite sure how the whole journey came into fruition within that specific time frame. What I mean by this is that, yes, the price action was started the session at the open down here. We don't know whether the price fell to the lowest point of the day, then rose, okay, near the close, went higher than that, and then came here, okay? Or the other explanation is that opened here, it went up there, came back down here, and then closed here, okay? So there is a lot of interpretation of what has happened within the day. So maybe another explanation would have been opened here, okay, went to the highest point, okay, came to the lowest point, then closed, or it started down here. We know the starting point, the finish point, or it started here, open, it went up to where it closed in hindsight afterwards, went down here to the lowest point once again, and then rebounded to the highest point, up there, and then close here. We don't know, okay? We are assuming, because if we're not looking at price action while it's being formed, we don't know what has taken place, okay? And we can make a lot of assumptions about this. It's unclear. Same goes for the bearish candle, for example. Yes, we know that it has opened here and closed there, but we don't know whether the price action opened here, it went to the highest point of the day, and then for some reason bad news arose and we see the price action falling rapidly down to the lowest point and closing here. Okay, so if we understand what information they convey, we have a much clearer picture to see what has took place within that specific time frame. Okay, so it's most of the times really hard, but if you're looking at price action from a minute to minute kind of time frame, you can clearly see what's going on. And if you pay attention to the journey, okay, of price within these specific frames, okay, it gives you information. For example, if we started here and we went up to the highest point of the day, that means that the bulls were in control. They wanted to push the price action to higher ground, but for some reason something happened, or the bears did not allow the bulls to take the initiative and push the price action to lower ground, and they reacted by entering the picture and selling that specific instrument aggressively, pushing the price action to lower ground, saying to the bulls that, you know what, no, that's not the correct price. We see in this kind of case not much resistance from the bears, from the bulls. The bears were in control. They pushed the price action to the lowest, for example, of the day, where the bulls said, you know what, you've had enough. We're not going to allow you to push the price action to lower ground. They enter the picture near the low of the day, seeing this as a nice entry point for them to capitalize. Okay. But at the end of the day, the strength of the bears was much stronger, was much graver, much bigger than the bulls, and they managed to end the session with a victory, if you like, if you can conceptualize that as a fight between the two. And they closed this session with almost all of their gains, because bears go short, bulls go long. So in this kind of session, the bears won. So again, it's a game of tug of war between bulls and bears at any given point in time. This is what the candlesticks are telling you. So understanding how the whole thing comes together gives you an indication of who is in charge. And if you know who is in charge, okay, you can extrapolate from there onwards with the usage of many other tools you have at your disposal, where the price action may hit towards to next. And we're not talking about specifically technicals here. We're going to use fundamentals as well. Okay, so you're going to see how the whole thing comes into fruition when we're going to do a live session, and I'm going to go over telling you or interpreting the price action and giving you a story of who is in control and why they are reacting in this kind of way if we have available data and all the kind of stuff. We're going to do that in the future. But for the time being, let's keep it simple. Candlesticks. If the open price is lower than the close price, green candle, bullish candle. If the open price is higher than the close price, that is a bearish candle. That means the bears are in control. This one means the bulls are in control. Okay. High and lows always do pay. We need to pay attention to, because they're telling you that for some reason this area is not acceptable, let's just say, by either of the two, or the bulls or the bears. So they push the price action to a level that for some area that they agree upon, that, you know what, this price in time, this point in time is the proper equilibrium for this kind of instrument at that point in time. Okay, so that's how you interpret this. So as we just mentioned, we have a lot of variation between how large the candles are in regards to size. So we have small, large, extremely large, etc. So the size does matter. This is not a euphemism. This is not a wink kind of comment here. We're talking about being serious here. The larger the candle is, the more substantial, okay, or more strong the signal is, okay, is given to the market by those that observe the price action. Okay, so strong buying pressure is indicated by long, big green candles with real body, but weak pressure is seen or interpreted as when you have a candlestick print that has a small body, obviously in comparison with one that came before it, or many that came before it. So usually large candles give you an indication that is strong buying pressure. Small candles, weak buying pressure. This is what information they convey. On the flip side of the equation, small red candles or bearish candles indicate that there is weak selling pressure. Large red candles tells you that is strong selling pressure. Size does matter, guys. Okay. So wicks and shadows. Let's go on and deconstruct this. So there is what we call the comparison between the upper body, the upper shadow, and the lower shadow. It does have implications as well, and you're gonna see what I mean by me explaining this to you. Okay, so open is obviously down here, close is up there, highest is up here, low at the point of the day is down there. So again, we're not quite sure what has happened, but looking at the end results, we can tell a story. Okay, so open price was down here. Bulls were super eager to push the price action to higher ground, which they have actually managed to do so. Okay, they push the price action up to the highest point of the day. However, the bears saw this and they entered the picture with a strong selling kind of bias. Okay, they forced the price action to come back down because they see, you know what, this level is not sustainable for this instrument for some reason. We're not going to allow you to push the price action to higher ground. This is the optimal price at this level, at this point in time. And you see the close is down here. So what we see here is that the prices most likely rallied throughout the day. If this is a daily candle, started down here, rallied with strong bullish sentiment and momentum, but the bears entered the picture and you say, you know what, no, this is not acceptable. I'm going to push the price action to lower ground. They have entered the picture and push it to lower ground. Let me see if I have available pen to do so. So maybe you can conceptualize it like this. Open price went here, went all the way up there, and they came back down to this kind of level. Okay, obviously we have excluded this here. So this price action, if you can conceptualize it with a line chart instead of a candlestick chart, may have looked like a hard beat. Okay, so something like this. So start here, may have fallen to the lowest point of the day. Okay, then the price action rose with enough strong bullish sentiment. Okay, and then we see the price action falling to lower ground and closing here. Okay, so what do we see here if you just put a real body candlestick here? Is pretty much the same thing. Okay, so this is the open price, this is the close price, this is the lowest of the day, so the shadow, and this is the highest point of the day. Okay, so this is the high, this is the low, this is the open, and this is the close. Okay, pretty much similar to this on this example right here. Okay, so this may be something that happened throughout the day. There is obviously a few more scenarios that may capture this kind of movement much more nicely, but we are assuming, because we have not looked at the 5 minute or the minute to minute chart throughout the day, we just look, let's just say this, assuming that this is a daily kind of candle. Okay, same thing as you got, basically completely the opposite. Is with the bearish candle that we have in front of you. Okay, open price obviously is up here, close price is here, high is this, and low is that. Okay, so we can extrapolate that price action opened up here. Okay, price action went to higher ground. The bear said no, not gonna go that way, we're gonna come back down. Okay, push it to the lowest of the day. Okay, but the bulls entered the picture. They saw this as a deep buying opportunity, and they reversed the course back up to this point where we see the close. Okay, once again. Okay, open price, close price, lowest of the day, highest of the day. Okay, pretty much the same thing with this. This is a logical extrapolation or a logical forecast or prediction of what has happened throughout the day. Or it may be something like, for example, it opened here, prices fell, okay? Maybe they rose back once again, making the high of the day, and then for some reason, super bullish, bearish sentiment arose, okay? Push the price action to this level here, but the bulls entered the picture, push the price action to here, and we have pretty much the same thing here. Okay, so open, close, let's just say this level, whatever. You understand what I mean? High of the day and low of the day. Okay, so it's an alternative kind of scenario there. You can make a lot of them. Okay, but this is what they convey. So strong selling interest. However, buyers force the price action to close here, the open. Okay, near but not at the open. Okay, so strong bullish bearish sentiment, bears were in control, the bulls entered the picture, finally managed to close the session near the open price. Okay, so this is how you interpret wicks. So interpreting individual candles. So we have another example that of a candle that you can come across when you look at price action in financial markets, what we call doji. Okay, doji candles, as you can see with this example right here, the open price and the close price is pretty much the same. So no real body. This is the definition of dojis. So the price action opened here, fell, okay, rebounded, okay, but it closed at the same level, okay? So no real body. So you can call this a cross, okay? This has supreme kind of, not predicting powers, but is this a significant, very, very, very significant candlestick formation or candlestick in general, because they tell you that for some reason, despite all this volatility and this rushing, okay, at the end of the day, okay, the bulls and the bears settled for this kind of price. So This is what we call equilibrium, the purest form of equilibrium. So they pushed, bears dragged the bulls, okay, in their territory. The bears fought back. Okay, you can conceptualize this again as a tug of war game. At the end of the day, the bears and the bulls agreed that this point in time, this level is the most appropriate one. So open price and close price are exactly the same or very, very close to each other. Okay, so a doji is a commonly found pattern in candlestick chart of instruments. So it's characterized by being small in length, meaning a small trading range with, this is the trading range, by the way. So the real body of the candle, the difference between the open and the close. So this is a bullish candle, by the way, because the open price is lower than the close price. So this is when we say trading range or TR, we're talking about this area, okay? Right here, okay? This is the trading range, okay? So the difference between the opening and the close, okay? So opening and closing price at virtually equal, okay? Same level. So it usually presents indecision. This is, if you want to take something away from this slide, is this. Doji represents indecision. They don't know where either the bulls or the bears, where the price action is going to head towards to next. Okay, or in other words, it's an equilibrium point. Usually, if it follows a long bullish candle and you see the doji, most likely, or the first assessment or the first assumption that you're going to make is that we have reached the top of a market and we're going to see probably a reversal afterwards. Obviously, depends upon many different factors, but looking at it individually, big green candle followed by doji and then by a red candle, that signals a reversal, okay, which is a super significant thing to spot and learn how to spot, because it can give you an edge when it comes to capitalizing upon these candlestick formations and making money and banking, okay? So a doji represents indecision in the market. So a doji is not as significant if the market is not clearly trending, okay? So if we have a market moving between two bounds, okay, two channels, and you see a candle, you see a doji candle being formed there, we don't care, okay? We need markets trending, okay? Moving to the upside, and at the top, you see a doji, okay? Super significant, gives you an indication that probably market has reached a top. No further upside is expected, only if you see the next candle being red with a long red body, okay, or bearish candle being formed at the top. So we're going to talk about chart patterns in the next few webinars. More specifically today, we're going to look at candlesticks individually. So let's stick to that. So if it's not significant, if the market is closed, is not clearly trending, in other words, no clear direction can be detected as, okay, non-trading markets are inherently indicative of indecision. So indecision on top of indecision. Okay, fair enough. Who gives a damn about this? Nobody. So this is insignificant. However, if the doji forms in an uptrend, much like the example we have here, so again, consecutive higher highs and higher lows, or in a downtrend, the completely opposite, this is normally seen as super significant, not just significant. As is a signal that buyers are losing conviction when it's formed at the uptrend. So they don't expect the price action to go further from here onwards. So if you see that at market tops, you expect to see the reversal. And on the flip side, if you see this at the market bottom, okay, you see a doji as the complete different interpretation, reversal to the upside, because sellers are indecisive whether the price action is going to move to lower ground. So most likely, if this is followed by a long green candle, this is a complete reversal formation. And we're going to see this a morning star and an evening star formation chart patterns. We're going to see them later on this webinar. Okay. So where do you see dojis is also of crucial importance. Usually at the tops and bottoms is super significant. In sideways price action on trendless markets means pretty much nothing. So types of doji candles. Neutral doji is what we call the basic doji, or just the star or the cross. Okay, dojis form when the opening and the closing prices are virtually equal. We just said that. Okay, open and close is here. This is the low, this is the high. So if the price, if the trading range is pretty much non-existent, if it's equal to zero, that means most likely you have a doji candle. At the end of the day, that's an indication, yes, that there is indecision. What we care about is the trading range of the entirety of the candle. Okay, so how big the wicks are and the shadows are tell us a lot about that specific period in time. So alone dojis are neutral patterns. So again, if you see that at top, significant, at the bottom, significant. If you see that between a trading range, insignificant again. So the other example is what we call the long-legged doji. Okay, so again, same thing, a doji, but it has a higher high and a lower low, obviously, when you compare that with this. Okay, again, same thing, open, close, high, low, but these wicks shadows and this wick is much larger than this one. That means there is, what you can extrapolate from that is that there is a lot of volatility within the session. So the prices went way up compared to the, obviously in comparison to the other one. And they have gone way lower compared to that one again. But at the end of the day, they closed flat. Okay, this is what we call flat. If you see a daily candle formation of a doji with this, you can say clearly that the session ended flat. It has severe implications. So the length of the legs do have predictive powers. They do have a importance, not predictive powers. They are significant indications. Therefore, we look at that. So the larger they are, the more volatile the market has been within that session. The smaller they are, the more consolidated or more conserved or more cautious bulls and bears were within that session. Okay, so other types of doji candles we call gravestone and dragonfly doji. Who comes up with these names? Nobody knows. So the main difference between the actual doji, the neutral doji with the gravestone, and the dragonfly doji is that the basic doji has a wick and a shadow, okay? Whereas gravestone dojis do not have shadows and do have wicks. And on the flip side, dragonfly dojis, they do not have shadows, wicks, the upper part, but they do have but they do have wicks. Shadows, okay? So what is missing here is, in order for this to be a doji, a neutral doji, is a shadow here and a wick up there. Okay, so this is for us to make much more clearer what we mean here. Okay, so gravestone doji, what does it say? Okay, open price, close price, exactly the same. What is the difference? Is that we have a high point, but we don't have a low point. The lowest of the day was the open or the close, because is at the same exact level. So what does this tell you? Is that the price action open here? There's not many interpretations. The price action, the bulls were in control, pushed the price action to higher ground, bears entered the picture, okay, and squashed the bulls' intents and equalized their strength in a sense, and we saw the price action falling to the close level, but it did not go below that. Okay, that means at the same time that yes, the bulls were in control, yes, the sellers entered the picture and erased every single gain that the bulls created, but they were not strong enough to push the sellers, meaning here, the bears. They were not strong enough to overcome that. Okay, that means the bears and the bulls were equally strong since the open of this session, of the open of this candle. Okay, so the gravestone doji, it is formed when the opening and close prices are at the lowest of the day, and this could be interpreted as a bullish signal. Okay, if it has a longer upper shadow, it signals more of a bearish trend, whereas if it appears at the market top is considered as a reversal signal, much like the actual one. Because what does it tell you? Because imagine that there is an actual bullish candle here. Okay, so it came from here, and you see that a market top. What does it tell you? Okay, super bearish indication, because the bulls wanted to push the price action to lower ground to form a new green strong candle, but the bears, the resistance was fierce from the bears. That is not a good signal, because they say, you know what, I'm not going to allow you. The bears are saying, we're not going to allow you to push the price action to higher ground. Okay, from here onwards, we are in charge, and we're going to drive the price action to lower ground. So if this is found at the market top, this is considered as a reversal signal. So weakness of the current trend, the bullish trend. Whereas if you see that on the top, or let's just say at the bottom, much more specifically, this is a bullish signal if this is found on a downtrend. Okay, because again, the same thing can be applied here: open, close, and the lowest of the day. That means if this is found on a downtrend, okay, so these are red candles, bearish candles, and you see the open price here, the bears doing what they want to do, so extending in a sense the trajectory to lower ground. For some reason, the bulls like this area, this region, and they say, you know what, I'm going to take upon this. I'm going to dip buy this. So they enter the picture and they buy, okay, and they push the price action at the market open, at the time frame open, signifying that there is strong bullish intent or bullish strength. Okay, opposite is here, so this is at the top, there is bearish strength. I'm getting better with this. Okay, not really. So pretty much this is what it is. Dragonfly doji is formed when the opening and the closing prices are at the highest of the day. So don't have any wick. This is the high of the day, the open and the close. If it has a longer, lower shadow, it signals more of a bullish trend. Okay, the larger this is, the more significant it is. Opposite is also true for this. The larger it is, the more significant it is. So when it appears at market bottom, it is considered to be a reversal signal once again. Okay, clear? If you have questions, please let me know, send them through. Okay, for the time being, I'm assuming everything is up and running correctly. Okay, so similar to the gravestone doji is no, excuse me, the dragonfly doji, this one is the hammer. Okay, with the exception being that we have an actual body here, so open price is here, close price is here. Okay, so this is not the same level. This is not a doji. Okay, so hammers are found in downtrends most of the time. You can find it in uptrend as well, but they are significant in downtrends. That's why we talk about them. So a hammer is a type of a bullish reversal candlestick pattern made up of just one candle. Okay, much like the much like the dragonfly doji if it's found on the bottom. Okay, same thing with hammer. So the candle looks like a hammer, as it has a long lower wick and a short body at the top of the candlestick with little or no upper wick. In order to form a candle, in order for a candle to be a valid hammer, most traders say that the lower wick, okay, must be at least 2 times greater than the side of the body. Okay, because this is buying territory. This is what happens, this area right here. Okay, so the larger this is, the more significant it is, or the proportion at least of the wick with the real body has severe implications. So the larger the proportion of the wick compared to the real body, stronger the signal is, and it's obviously bullish. So, and the body of the candle must be at the upper bound of the trading range. Okay, so when you see the hammer form in a downtrend, this is a sign of a potential reversal in the market, as the long lower wick represents a period of trading where the sellers were initially in control, but the buyers were able to reverse the control and drive the price action back up towards the close near the high of the day, hence the short body. Okay, after seeing these chart patterns form in the market, most traders will wait for the next period or time frame, or whether that is a minute, a 5 minute, 10 minute, whatever that is, or a daily chart. They want to see the next candle before entering the picture. Okay, so waiting and seeing. Yes, you're going to leave money on the table, but you're going to be much more confident in your assessment that this has been, let's just say, a reversal formation. Okay, so imagine this. Okay, so moving south, you see this, and then you see that, a green candle, reversal. Okay, this is what it signifies to traders. So after seeing the chart pattern form, most traders will wait for the next period to open, and then the close of the previous period to confirm that the buyers are actually in control. So two additional things traders will like to look for in order to place much more significance in this kind of pattern are a long lower wick, okay, but also an increase in volume. Super significant is the another extra dimension that technical analysts look at when you do their analysis. So you have, as we mentioned, price, open interest, and volume. Price is the most important, volume is supplementary, comes second, and third is the open interest. So if you have this formation, okay, a long lower wick, proportionally speaking, with the real body of the candle, and you have the confirmation that the next candle is a bullish one, and you have the confirmation that the volume around this instrument is increasing. Using only this, you can actually trade it. Okay, a bullish reversal sign has a high degree of probability of coming into fruition and price action rebounding from the lows. Okay, moving on, and we're running out of time. Moving on, we have what we call a shooting star, complete opposite of the hammer. So shooting star patterns are found in uptrends, and that's why they are important. So a shooting star is a type of a bearish reversal pattern if it's found during an uptrend. Okay, price action moves to higher ground, and you see that at the top. Same thing applies here. The next candle must be bearish, should be lower, and therefore we get the signal for a reversal if it's found at the top, because it signifies that the buyers drove the price action to high ground, bears into the picture, and settle the price action of the day within this close range. Okay, this is bullish, this is green. Okay, which is at the end of the day says that indicates that the buyers drove prices up at some point during the period which the candle was formed, but short selling pressure drove prices back down for a period closer to where the market has opened. If this occurs in an uptrend, the selling pressure is seen as a potential reverse signal. Okay, again, the proportionality kind of parameter also applies here. So the larger the wick is compared to the real body, the more significant it is, because it signals much more strong selling pressure. Okay, so when encountering these parts, and traders look for a lower open on the next period. The open is down there, close is there, but also you need the rise in volume as well, okay, in order to consider this as a valid reversal pattern. Okay, shooting star, hammer, complete opposite, have indication. So let's go ahead and look at a few complex candlestick patterns. We're going to see them in the next webinar as well. We're going to do chart patterns. So some examples of a bearish continuation pattern is you have bearish sentiment or a large bearish candle, a large red candle, followed up by 3 small candles that do not exceed this trading range. One green candle, second green candle, third green candle, but they don't exceed this area, this range. And you see the next candle open here, close there. And if you see this red candle following that and erasing, in a sense, the progress that these 3 candles have made, okay, this is considered to be a continuation pattern that the price action is going to continue south from here onwards. Okay, so if you spot these 3 white soldiers kind of pattern formation, this is what we call them, you're pretty confident that the extension towards the downside is going to continue. The main trend is going to extend it into the future. So it has a long black body or red body followed by 3 small bodies or red green candle bodies, normally white or green, and afterwards the final one. So it's a 5 candlestick formation, even though the third, we're talking about 1, 2, and 3. Okay, so if you see this 5 candlestick formation, you are pretty sure that the extension is going to continue. So 3 white bodies are contained within the range of the first black body. If it exceeds it, it is not continuation pattern. This is not the signal that we look for. Okay, so this is at the end of the day a bearish continuation pattern if it's obviously coming from a bearish trending market. Okay, like this. Okay, so this is considered to be a rebound. This kind of move is the rebound. Okay, so a temporary pullback, you might call that. And afterwards, we see strong selling pressure extending price action to lower ground at the direction that it was supposed to go in the first place. Okay, so these 3 candles serve as a temporary interruption of the main direction of the market. Okay, bullish continuation patterns. So completely the opposite. 3, we're talking about 1, 2, and 3 bearish candles. They are in black. These ones are, you can call them bullish candles or green candles. So same scenario applies here. Long, big green candle followed by 3 small red candles, bearish candles. Okay, and 3 black bodies are contained within the range of this. Okay, so they do not exceed this trading range. If they stay within the range, 1, 2, 3, and then a follow-up big green candle rises, have high degree of confidence that the price action is going to head north from here onwards. So you need to see the 5th, okay, candle or the first candle that comes after the 3 being big, okay, and exceeding the prior trading range, have high degree of probability that this is going to be a continuation pattern, more specifically a bullish continuation pattern, assuming that it comes from down here. Okay, and the next one is probably going to be up there. Okay, simple stuff, I assume. Okay, this is what we call the 3 black crows. So it consists of 3 long black candlesticks with consecutive lower closes. So once again, if these are bearish candles, this is the open, this is the close. Obviously, this is the open, this is the close, open and close. Consecutive lower closes and lower opens. Okay. So they need to be near and around and about the same area. And we'll call these 3 black crows. If you see this at the top, this is a reversal signal. Okay, assuming that you have this. Okay, if this is at the market top, call this a reversal signal or maybe just a temporary pullback. This ultimately depends upon what kind of candle is going to follow from after this thing. Okay, so three white soldiers, completely the opposite. So open is here, close is here, open is here, close is here, da 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 da. Okay, round and about the same area. Three bullish candles back to back. Okay, if you see this at a market bottom, okay, this is a reversal kind of signal. Okay, bottom reversal signal. It's a bullish indication that you may see as the rebound taking further place going onwards. Okay, so the closing prices are near or to or at their highs. Da, da, da. If it appears at the bottom, is interpreted as a bottom reversal pattern. Okay, simple. I hope this is simple for you guys to follow. So we have last one, which is going to be the morning star. Super easy to spot. And we have also the evening star, is not in this slides. It's going to be probably on the continuation on the next up and coming webinar. It's going to be about chart patterns. So the morning star is a pattern we see in candlestick charts when these, which are used by technical analysts. Yes, we said that. Which describe and predict price movements of a security derivative over any currency at any given point in time. So the pattern is made up of three candles, main components, normally a long bearish candle, followed by a short or bullish or bearish doji. May not have an actual real body at all, maybe just a low doji, with the follow-up being a green candle, a bullish candle, okay? That opens way above the open and the close area that we saw on the doji, okay? So you can visualize this like this. So bears are in control, push the prices to lower ground. The bears, again, continue to push prices to lower ground. The bulls enter the picture and they push price action to higher ground. However, they finally settle here. Next session, they open up there and they close the session near there. So erasing, in a sense, these 2 days of losses with strong retracement, with a strong rebound. This is considered to be a reversal pattern, and it's only considered to be a reversal pattern if it has 1 and 2 and 3 with the same kind of structure that we have explained so far. In order to have a valid morning star pattern formation, most traders will look for the top of the third candle, this one, okay, to be at least halfway up of the body of the first candle, okay? So halfway somewhere in here, close is there, okay? So above it, perfect, okay? So black candles indicates falling prices and white candles indicate rising prices. So black candles are the red ones, the bearish ones. White candles are the green ones or the bullish ones, okay? Simple. So interpretation, just to go through the whole thing once again, and then we're going to finish. So this is, if this is found on a downtrend, this is a reversal pattern, super, super important. So a large down candle representing selling acceleration, obviously, okay? The doji represents indecision, obviously. And the long white candle represents buyers taking control, okay? So when found in a downtrend, this pattern can be an indication that the reversal in the price trend is going to take place. Now, what the pattern represents from a supply and demand point is the view is a lot of selling. There is a lot of selling in the period which forms the first black candle, okay? Then a period of lower trading and indecision and reduced trading range is indicated by the doji, which forms the second candle. And this is followed by a large white candle or green candle representing the buyers taking control of the market. That means the bulls have exhausted the bears' intent and strength, and now they have strong momentum to push the price action to higher ground, okay? So as the morning star is the three pattern candlestick formation, traders oftentimes will not wait for confirmation from the fourth candle before buying, meaning this, and they want to see and start taking positions within this area if and only if you see high volume. If you're not, you wait for the fourth candle to arise, and then it's highly suggested to do such things to be sure in the sense that the reversal has taken place. Because if you on the mid level of this kind of session, you just go from the open, you go long because you expect this candle to be a long green candle, but if it closes down here, you jump the gun. Most likely this is not going to be a reversal pattern. You're going to be leaving yourself exposed. So that's why you wait for the third candle to materialize and then enter the position. Again, this is up to you. You can trade this accordingly. So also, finally, we're going to say that traders will often look at the size of the candles for an indication of the size of the potential reversal. So the larger these candles are, the more significant they are. Okay, so you can spot a lot of them if you scroll through charts. They're super accurate. They found at bottoms. They are signal of a bullish reversal pattern. Capitalize upon this. Why not? So the larger the white and black candles are, and the higher the white candles moves in relation to the black candle, the larger the potential reversal. Okay, pretty self-explanatory, easy for you to comprehend. I assume and I hope. Okay, so this is gonna be it for today's session, guys. We have reached the time limit. Hopefully you have enjoyed this kind of webinar. You have got something out of it. If not, you can find this on our YouTube channel. You can watch it at your own time to clear up any sort of misconceptions that you have. If you have any sort of questions, please do send them through right now. If not, we're going to leave it at this. For the time being, I have seen no questions. So, yep, let's just leave it here. Thanks for watching, guys. We're going to catch you until next week for the webinar technical analysis on chart paths informations. Feel free to join. Going to see you then. For the time being, take care. Bye-bye.